Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Deere Company, known for their famous John Deere tractors, and do a stock analysis on them. But before we get into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get good ideas for potential stocks to buy or value drops to avoid, make sure to subscribe to my channel since I'm putting out new videos constantly. If you do want me to cover a video like this one, which was a subscriber request, leave it in the comments below. So let's first look at some of these higher level metrics for John Deere and see what they're saying. First of all, I like taking a look at this little guru focus value band here. It is saying it's a little bit undervalued, and also with a PE of 11.44, I think this is definitely why people are interested in this stock and thinking it could be cheap right now. But we're going to look at the fundamentals and basically see if that is the case or there's something else going on. They do have a forward PE of 12.05, meaning they're expecting the EPS to drop a little bit in the future. At least that's the consensus of all the analyst estimates. But let's dive into the financials now. So first of all, we kind of take a look at the revenue trend here. You see they kind of do hit these, they do sometimes decrease in revenue, but the long trend is up basically. So you kind of have slow patches and hot patches. We recently have gone through a hot patch right now. A lot of it's because commodity prices have been up a lot. As we know, that was kind of sparked by with the war in Russia and a lot of other economic things that have happened in the last few years. But over the last 10 years, the average revenue growth has been 5.7% and EPS has been 9.6%. So we're going to go down. I actually want to open up the 30-year financials because we want to look a little bit further in the past for this, because I have a few things I'm going to want to go over here. So let's go right down to the income, because this is where this all starts. And let's look at the recent trends here. You can basically see over, like we said just on the revenue before, it's been going up. They have little slow patches, sometimes decrease, and they get into hot patches. And then we basically look at their gross margin, and the gross margin is up significantly. Basically, in the last 12 months, it's almost 36%, with the last quarter being 38%. And this is much more than it was before, because pretty much in all these years before, you can look at this whole stretch from 2005, for example, to 2022, and they've maybe averaged around 29 to 30% during this whole time. So typically, when you would see the gross margin increasing like this, if it was on a steady trend, it could mean they're gaining competitive advantage. But I think this is a little bit more due to cyclicality, which I'll explain a little bit later in the video. But let's first go a little bit further back in the financial data here. And you can see if we go back into the earlier in mid-1990s, they did actually have a higher gross margin before in the early 1990s, where it was around close to that 35%. It did kind of drop down after 2000 into the high 20s, and that's where it's been maintaining at around the 29-30%. So I'll get into this a little bit later, but I do think it's most likely we're probably going to see John Deere revert back to their 30% gross margin. So sometimes you can't just look at the first few years. You have to look at the long-term trend and understand a few other things of what industry they're in that relates to why the numbers were going up. So I wouldn't say they're getting competitive edge at this point. They're just maintaining it, but they're still very good. 30% gross margin is great. We basically look down at their operating margin, and right now, again, way higher than it usually is, 23%. Even the last 2 years were a little bit on the higher side of above 17, because you look at all these years before, and it was sometimes as low as about 8. On the other high side was maybe at about 14%, and that's pretty much going back historically almost to 1993. It was never really higher than 14%, and we're seeing a very abnormally high operating margin. So it's kind of, when you see something that's out of the blue like this, unless there's a real big fundamental reason, which for a very mature company like this would seem very unlikely, you have to realize this may be due to some current economic circumstances and is not going to maintain. Next, let's take a look at their interest expense. Interest expense right now, in basically the last 15 years, they have started taking on more debt, and they do have this interest expense now, which I'm frankly not a big fan of. It's $2 billion, and operating income right now sitting at about $14 billion, even not the best coverage ratio for that. And if this operating margin was, for example, to revert back to historical norm and get cut in half, then they'll be only making $7 billion in operating margin with $2 billion of interest expense, which I would not be happy to see if I was an investor in John Deere. So that is a little concerning, the high interest expense to me. It means, they have been taking on a lot of debt, or just the rates for the debt have gone up in the short term, which means they may be at some variable rates. Either way, not so great in my opinion for that. But you can see overall, regardless, out of all of this, net income has been very positive, although it has really exploded up in the last few years due to these higher margins. And also the EPS has been exploding up even at a much faster rate. Why is this? Well, they do buy back a lot of shares. You can see basically in the last, now they're down to 292 million shares. And if we compare this to about 10 years ago, they had 400 million shares, so they have been aggressively buying back shares over this period. I probably would have liked to see them paying down some debt to get that interest expense down instead of buying back shares, but at least so many shares. But now let's take a look at their balance sheet. So we'll take a look at their current assets, sitting at just over $77 billion, and total current liabilities of only $39 billion. So this is a very good current ratio. Obviously, John Deere, they're very profitable. They have, a very good current ratio. They're not going to be going bankrupt anytime soon. It's really just a determination if is the stock going to be a good value or not. And basically, total assets sitting just over $100 billion. A little bit of intangibles and goodwill. I think, the intangibles is probably related to some proprietary, either, their branding, the software they have, some other machinery stuff. But regardless, $4 billion of its goodwill. I would kind of consider these other intangibles probably real. And that's, total assets of $86 billion and total liabilities of $80 billion, basically. Leaving us, no, that was total assets of $103 billion. So that's what they're at. And the total liabilities of $80 billion for a total of basically $23 billion of total equity, although I would take the $4 billion out for goodwill. And we're also going to have to look at their depreciation kind of to see if this is really an accurate number overall. But this in their long-term liabilities here, you can see in the long-term debt, it has been increasing up quite a bit, $38 billion. I'm not a big fan to basically see that much long-term debt they've taken on. And the more and more they're taking on, they're paying interest, which I think they should be paying some of that down rather than buying back so many shares. But overall, a pretty good overall strong balance sheet, at least from the current ratio. And they do have around, we're looking at possibly around $20 billion of total equity after we take out the goodwill. So let's see what basically on the cash flow statement here. I'll look at their depreciation. Basically, depreciation has been getting higher in the recent years because that's just the way it is. And that's the trend it's going at. Before, about 10, 15 years ago, we were around $1 billion. Now it's closer to about $2 billion. And their replacement, they have been purchasing, but they also have sale of plant, property, and equipment too. So we have to factor those back out. So when we kind of look at the purchase of plant, property, and equipment, and then the sale of plant, property, and equipment, this does look a little bit closer to replacement value. So the assets we're seeing on their balance sheet probably are pretty accurate, and from whatever they're selling, they are able to get money back from it. So they probably do have some real tangible equity on their balance sheet there. They also do tend to do these little purchases of businesses along the way, although there was a really big purchase in 2018 for $5.2 billion, but it's not a typical business for them. A lot of these are just a few $100 million or under $100 million overall. So very small acquisitions, but this does seem to be consistent business activity for them, is doing these little acquisitions. And then we can basically see repurchase of stock, like I was saying. Lately, they've been repurchasing a lot of stock, and I go on this about a lot of videos, but I'm not always the biggest fan when companies do really well. They repurchase a lot of stock because sometimes that means they just end up buying stock when the price is really high. So you can basically see in the last year, they've purchased almost $6 billion of stock. And if the stock was cheap, this would be great, but we need to determine if that's the factor, because then sometimes they stop these repurchases, and I'm going to just guess right now, that's probably when the stock price is a lot cheaper at the same time. So personally, I would rather see John Deere scale back the repurchase of stock, maybe issue a little bit more of a dividend instead. They do pay a little bit of a dividend. The dividend's probably going to be completely stable, and you're not going to have trouble affording it because the other fundamentals are pretty good. But rather than purchasing so much stock, just pay back a little bit of the debt, make the repurchase of stock a little bit more consistent. But overall, with all of that, free cash flow is pretty good. You get some years which are a little bit off, but it's not really a big deal because when you actually do look at the cash after the cash flow from operations, a lot of this can be affected basically from their purchase of investments and sale of plant, property, equipment, because this is not necessarily all these types of other investments are not always captured into the free cash flow. It's nearly just your cash flow from operations minus your capex. So overall pretty good. Company's stable, not going to be having problems with that. So let's take a look at basically the interactive chart to get some idea of this relative valuation. So we basically look at the revenue with estimate, and they are expecting to have more flatter revenue in the future, although this may not be super accurate because, as I will show a little bit, there is a little bit of cyclicality that is related to basically a stock like them. And let's go with the EPS with estimate. And EPS, again, they're expecting to go down a little bit next year, potentially be flat. Either way, in any scenario, we're probably not going to see John Deere growing their EPS or growing their revenue in the next couple of years. We're probably at the best case scenario looking at something that's flat. Now let's take a look at their price to sales ratio. This is one way I like to look at relative valuation, and you can kind of see again there's this correlation you get when the price to sales ratio low. The stock's usually pretty low at that, although this isn't always the greatest metric to use when the revenue can bounce up and down, but it's still pretty good. But if we take off the price just to get a little bit clearer look at it, it is sitting quite high. Now if net margin were to maintain at these higher levels, we probably could justify this higher price to sales ratio, but again, I actually don't necessarily think that's going to be happening. So let's just bring up the net margin here, and I'm going to take off the price to sales ratio so you can see that a little bit clearer. As you can see in the historical almost history here, this has been about their high level, as we went over before, of their net margin. Sometimes when things go a little bit off, they'll go lower, and now it looks like they're a little bit on the abnormally high side. So that makes me a little bit worried. Let's also pop up their dividend yield, since while they do pay a small dividend, they are fairly consistent with it. And you can see the dividend yield is sitting quite at a low ratio right now, so that could probably be some overvaluation. We compare this to the price, and what do we see basically when you have a high spike in a dividend yield for companies that are kind of consistent in raising their dividends and paying out a consistent amount of the actually EPS that they're making, the price was low. So right now, from both perspectives, I would say John Deere is looking a little bit overvalued, even though they do have what it looks like an attractive value of only 10 PE. So now I'm going to show you a little bit about this commodity cyclicality that's related to them. So basically, we have John Deere with the candlestick chart, and the orange chart overlaid here is wheat futures. And you can definitely see there is some correlation. It's not perfect, but typically ballpark around where you get these high points. Let's just get our little drawing tool here. We had a high point in wheat there, a little bit of a high price there in it. Same thing here back in the 1980s. There was a little bit of a correlation here in 1989. Wheat price is high. Stock kept going up for a little bit further, but then it shortly hit a little peak afterwards. And then basically in 1996, a peak in wheat price there. And then a couple of years later, a peak in the stock price. 2008, basically, a peak in wheat, peak in the stock price. Another kind of in 2011 and 2016. That's 2012. There was a little bit of a peak in wheat, and also that was a short-term top in the stock, although it wasn't incredibly overvalued, so it just went sideways for those years. And what have we had right now? Well, we've had this big peak in wheat price, and the stock looks fairly high up there. So I do think there is a very strong correlation to basically the commodities market and something like John Deere, or at least the agricultural commodities market, since they effectively supply machinery and tractors for that industry. So with wheat prices coming down, if they may maintain down like they have in the past here, we could potentially see quite a big drop in the price of John Deere. So I honestly wouldn't be surprised to see this come under $200. A 50% dip in an individual stock is not actually that big, but right now I think it's at a little bit of a cyclical high. Basically, they have higher gross margins that are not that usual. It's, I think, probably related to this recent high in wheat, even though wheat has been coming down. You can see in the past, just like in the 1990s where it happened, when it peaked, stock kept going up for several years as the price of wheat came down, but as wheat maintained low, the stock came down to basically follow that. So I would be careful with John Deere. Would not be personally a buyer of it right now. I'm not recommending shorting it or doing anything like that, because if the wheat prices were to hop back up, that could justify the price maintaining at this level. But it seems very likely we're going to see the margins contract in the future and potentially revenue contract in the future as well. So I hope this gave you some insights into John Deere or Deere Company. I hope you like the stock analysis. Remember to subscribe to my channel, like the video, and I'll see you in the next stock analysis video.